So let's talk about LandBridge because their latest earnings call was a real head scratcher. On the surface, the company reported an absolutely killer quarter, but the stock got hammered. So what on earth is going on? Let's get into it. All right, so check this out. This is the whole paradox in a nutshell. On one side, you've got revenue growth of 78%. I mean, that's just staggering. And an 88% EBITDA margin. Those are numbers that should have investors popping champagne. But on the other side, the stock dropped over 8%. So what gives? What did the market see that we missed in these headline numbers? Okay, to figure this out, we got to start with the numbers. Let's really dig into the data from this quarter. Yeah, the top line, it was just fantastic. Revenue shot up to $50.8 million. That's a 78% jump from last year, and it even nudged past what Wall Street was expecting. So far, the story looks great. But, and this is a big but, here's where we see the first crack in the armor. Earnings per share, or EPS, landed at 26 cents. The problem? Analysts were expecting 29 cents. And look, a 10% miss on earnings, that's definitely enough to make investors nervous. And it was the first real sign that maybe this quarter wasn't so perfect after all. Now, even with that earnings miss, you have to understand this business is just wildly efficient. Take a look at this. They took almost $51 million in revenue and turned it into nearly $45 million in adjusted EBITDA. That's a core profitability measure, and it works out to an 88% margin. And a huge piece of that just becomes pure cash. This company is an absolute cash machine. And what's really interesting is how they make this money. You might think it's all about oil and gas, right? Nope, that's barely a blip on the radar, just 1%. The other 99%? It's from really stable stuff, like leasing out their land for infrastructure. Think of them as a high-tech landlord. And that's the story management is selling, right? Predictable, super high-margin cash flow that doesn't care what oil prices are doing. So with those numbers in our back pocket, let's switch gears and look at the story management was telling on their call. They had the strong revenue, but they really needed to sell their vision for the future. And the CEO, Jason Long, he came out with a lot of confidence. He immediately framed this as just the latest chapter in a long story of success. The message was clear. Hey, this is our 6th straight quarter of growth. This is just what we do. And this is where they walked everyone through their playbook, which is actually, pretty straightforward and smart. They buy huge chunks of land that aren't being used to their full potential. Then they get it ready for development, and instead of operating things themselves, they just sign long-term leases with partners or sell off pieces. The final and maybe most exciting step is adding new revenue streams like infrastructure for data centers and power grids. It's a model they can just rinse and repeat. It's built to scale. And they didn't just talk about it. They showed the receipts from this quarter. The solar project deal, that lease with ONEOK, that's the playbook in action. They even reaffirmed their guidance for the whole year, which signals confidence. But the real bombshell, the thing that totally took over the conversation, was this massive $250 million acquisition of the 1918 ranch. And honestly, this is where the wheels started to come off for the market. All right, let's get to the juicy part, the investor Q&A, because this is where that confident narrative really started to get challenged. And here it is, the elephant in the room. The entire negative stock reaction really comes back to this one thing. It all boiled down to one huge question. Did LandBridge just pay way too much for this new land? And did they take on a mountain of debt and risk to do it, especially right now with the market being so uncertain? And this right here, this shows the total disconnect between the company and Wall Street. You've got management playing the long game. They're saying, yeah, we paid about 12 times earnings for it, but trust us, we'll grow it so much that it'll look like we only paid 3 or 4 times. But the market is freaking out about the price tag right now. Management is excited about all the new tech infrastructure they can build. The market is just looking at debt levels jumping up. Management says, hey, we've done this before. Investors are saying, this is a huge asset. What if you mess up the integration? So what are we left with? You've got 2 completely different stories. The company's vision of long-term growth versus the market's fear about short-term risk. So let's try to cut through all that noise and give our verdict on where this is headed. Okay, so if we take what they told us for the full year, we can kind of back into what Q4 needs to look like. To hit their target, they'll need about $46 million in adjusted EBITDA. And honestly, with the momentum they have, it feels like they're going to land at the high end of that range. This tells us the core business is still firing on all cylinders, despite all the drama around the acquisition. Okay, but what does that mean for the stock price? That's what we all want to know, right?
Well, we think the stock is going to go into a holding pattern for a while. The market has already punished the stock for this deal. The risk is baked in now. It's what we call a show me story. The stock will probably just trade sideways until management can deliver some real proof that they can make this 1918 ranch deal pay off.
So, putting it all together, our final rating is market perform. The bull case is clear. This is a high-margin business with a proven way to grow. The bear case? They just bet the farm on a huge, risky deal. But with the stock already down big, we feel that risk is fully priced in now, which makes for a pretty balanced risk versus reward situation from here. So that's the real question, isn't it? Do you trust management's track record and their long-term vision, or do you side with the market's fear about the here and now? The next few quarters are going to be absolutely critical in telling us who was right. And remember, this is not financial advice.